Hey everybody, I hope you're having a fantastic day. So far this week hasn't been super exciting, at least from an index perspective. Below the surface, we certainly have some movement, some big cap tech making new highs like Meta, Amazon, Apple. But we talked last week about how we would push higher in all likelihood into that all important 60-50 level. Why is that level important? Well, that's where the upper call strike of the JPM caller strategy is sitting. What's a caller? It's where you sell the upper call in order to finance a downside put or a downside put spread for protection. And it just so happens that we're moving right into that very big strike right around that 60-50 level, very similarly to how things went back at the end of September before the structure was rolled to the end of December. So we had markets really kind of sit around for quite a while until that structure was moved. And the pin is really what happened there. And what the pin is when basically around a very big call strike, you have people who need to sell a lot of stocks above, a lot of stock above it, and you have people who need to buy a lot of stock below it. And it kind of creates this effect where the ranges get narrower and narrower until you have the pin. And it really felt like nothing was happening. Then after that disappeared, we were free to move up towards that 5,900 level. Then, of course, we pulled back, a little bit of nervousness set in into the election, and the rest is history as the market really was in favor of that very sweeping Trump win. Then, basically, this level becomes resistance for us. As soon as we pop through there, it becomes support. Resistance becomes support. We pulled down into this level. We bounced off of here a little bit as we got a little bit nervous towards those NVIDIA earnings. Markets digested it, and we've popped up and towards this very important level again. So let's go take a look at the other market, the NASDAQ, of course. Now, this is one of the things that we needed to happen in order for this rally to become a little bit healthier, right? We've got this market that's pulled back as well, but now the NASDAQ has participated. It has had a lot of trouble over the last 5 or 6 months getting back on board the train. And part of that has been NVIDIA. We'll talk about that in a moment. NVIDIA is still a little bit reluctant to join the party, but we've seen the NASDAQ now hitting new highs. That was important for us to complete this idea that we're going to have a nice Santa Claus rally into the end of the year. Now, NVIDIA, I think, should probably participate as well. We've had a little bit of trouble there. I got out of some short put positions because I wasn't comfortable with this particular name. They had good earnings, but not spectacular earnings, which is really what the market has come to expect from this stock. And so it's been sitting around a little bit. I'd like to see NVIDIA kind of around 145 to 150 and really to get a little bit more constructive on it, I'd like to see it around 152, 153. If that happens, I think 170 is a pretty good likelihood at that point once the momentum gets going again. So let's take a look at the TLT. This is another important part of this story. We saw the MOVE index, which is rates volatility, extremely high, much higher than the VIX from a relative standpoint in terms of how things generally look into an election. A lot of nervousness on the rate side of things, and we've seen the move come in very nicely. And we've seen TLT start to bounce back. I think that's a very important thing because we don't want rates to be higher for longer. We don't want markets nervous about either growth getting too strong. We don't want inflationary concerns to come back. So we don't want that 10-year, which we're going to take a look at in the moment, to stay around 450 or above 450. And the TLT is starting to rally. I think this is all part of my warm porridge theory, which is the market doesn't like things at extremes. It likes things to be just sort of okay. That's a really happy place for the market, especially with strong GDP, strong employment, etc. So the TLT is looking good. I think what we want to look at next is the 10-year. Look at the 10-year. We've come down. We were starting to push 450 again. This was, I think, of some concern to markets because if we get that, of course, rates compete with the stock market. And so stocks are going to have a little bit more trouble rallying with rates at 450, let's say between 450 and 5%. 10-year rates have come right back down into that 420 range. And I think that's a happy place. You don't really want them at 360 and you definitely don't want them at 460. Right in here is kind of my warm porridge, happy picture for the stock market. So I think this is a very important element to having stocks continue. And then again, we have VIX here. We had a very stubborn VIX, very, very high for a few months there. And we've come down. We got crushed after the election. We played that vol trade very, very well at OP. And we bounced back recently. And that was another opportunity to play the vol crush again. And so here we are down around 1320. Might be a little bit of nervousness surrounding South Korea, some other geopolitical events, the usual suspects in Ukraine and Russia. So it may keep us up a little bit, but I think we should see the low 12s, mid to low 12s over the next couple of weeks if everything works out on the non-farm payrolls at the end of the week. And I think the coast is clear, a little bit more clear at that point. Now, is there opportunity out there? Volatility is getting crushed everywhere. So what do we do as income sellers? We're looking for calls to sell. We're looking for ways to generate that extra little bit of income, harvesting those options. Now, we can look at something like Walmart, which just continues to do well. I wouldn't want to get super bearish on this stock. There's really nothing in this picture that leads me to believe that it's going to slow down anytime soon. We've got a very positive MACD. You've got a stock that keeps reaching new highs. Moving averages pointing in the right direction. I like that all-important 9 EMA that I like to watch. We're above that. We keep bouncing off of it. Look at how that happens in a very strong run. We keep bouncing off the 9 EMA. A little push below, bounce off the 20. Bouncing off the 9 all the way through here. And here, as long as we stay above that 9, I think Walmart still looks pretty good. What you want to do is look for that to be violated in some way. And if it does, that could be your opportunity to sell some calls and in an effort to generate a little bit of extra income on that holding that you've done very, very well on. So we talked a little bit earlier on the ticker show, talked about selling those 95s, trying to grab maybe 1.6, 1.7%, total of about a 3.5% call away return, which is the return you get if you're called away on your stock. Very, very reasonable out to January at this point. And another thing I like to look at is skew. So what that is how expensive are puts versus calls, calls versus puts. Anything above this zero line here means that puts are more expensive. That is your typical picture for the stock market, certainly for index, maybe not for something like a Bitcoin or gold, but for most instruments out there, risk assets, you're going to have this higher downside put skew versus the upside call skew. Right now, we're seeing something very unusual for Walmart. We're seeing upside calls more expensive than downside puts. That is a green light for us to, number one, sell some premium, sell those out of the money calls and grab that little bit of extra premium, grab that little bit of extra vol edge. And secondarily, to potentially put on a caller. We're going to sell those expensive calls to buy some downside puts or put spreads, just like the JPM caller. So hopefully that gives you guys a few interesting ideas, and we'll see you in the next video.